Toronto home prices have fallen substantially. This is where they could bottom? Interesting. Report from RBC. That'll be the first article we'll be covering. And the second article, different media source. Same report, but different headline. Has the Canadian housing bubble burst? Keyword burst, right? It gets lots of click. And that could depend on time and place. And the next one we'll talk about here is Tiff Macklem saying that we will come out of this alive. Well, they didn't say alive, I added alive, but basically saying that we'll come out despite having more rate hikes. So again, be prepared, and we'll probably get one in December. Then we got the next one, Romsfin, which is a mortgage investment company, a MIC, right? They are now freezing redemptions and what this could mean and does this spell trouble for the real estate market. Then we got our favorite mayor talking about how we need a massive tax hike that's coming, or we're going to start cutting services. And all this is basically still a lot of news coming your way on what's happening in the Toronto real estate market, because it's just never ending right now. There's just so many headlines, right, that is related to real estate and the economy. So if you're looking for some kind of help in navigating this wild real estate market right now, you can book a call with me using the link that's on the screen. It's right here, www.chatwithzen.com. Simply click on a date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the Greater Toronto Area, on top of making wicked educational content like this for you. Now, the first article we'll be covering here is Toronto home prices have fallen substantially, and that's in quotes. RBC says this is when they could bottom, right? So I have something that I highlighted here. They basically said that nationwide, our view is that the benchmark prices will fall 14% from peak to trough, and probably a bit more in Ontario. So I'm going to reiterate this again. So our prices have stabilized for the last 4 months or so they haven't really moved, plus or minus like 0.25%, give or take. And from the peak, which is February, to the bottom, which I would say is July, we fell already about 19.8% or something like that in all of GTA. So let's just round it up and call it 20. So we have already experienced that. So I would actually call it a crash, and I called it a crash like a few months ago in regards to the pricing, right? But it's stabilized right now. Now they go on to talk about how the data shows that the real estate market is generally flat from July to September, with 6,300 to 6,900 resales, which is taking place during that time. I'm 100% confident that is an error. I'm pretty sure they mean we've had 63,000 sales from January until now. There's no way we had 63,000 sales in the last 4 months, right? So that's just something I want to point out to you. But we have very, very low sales because we have a 20-year low. We had really strong in the first 3 months, and then if we bring it to the last 4 months, it's been 20-year low. So when you bring it to 60,000, that's really bad. Last year, when we were on record to break every record, we were like 120, and I think we average about 90,000 in the last 8 years or so, right? So we are very, very low right now. So don't let the prices being stable in GTA say something else. It is very, very low. Now, according to the guy who's quoted in the RBC report, he's saying that it's time to watch out for spring 2023. And I said that before as well, because it may open some doors for buyers who have been waiting on the sidelines. Look, I think 2023 is going to be a big telling point about what's going to happen, because I said that about fall this year. That just happened too. And we saw no sellers come up. So we're all kind of just waiting on the inventory game of how much stuff comes out versus how many buyers there are. And it's going to be dictated by buyer sentiment, right? And how confident they are in the economy going forward and what the interest rates are looking like. So the thing that I would argue that's different, and what he says here, is that at some point we would expect to see affordability start to improve, given, hopefully, by then interest rates would have reached their peak and big declines in prices will start to flow through better affordability. We've talked about this many times before, right? So I don't agree with what he says, because if prices go up and rates come down and they're kind of on the same trajectory, your affordability hasn't changed anymore. Your monthly payment is still the same. For affordability to actually change, you would have to have rates peak and then prices continue going down. So if that's his assumption, then yes, affordability can be for the better. But if he's saying for the fact that if rates come down and prices stay the same, then yes, that could work too. But I don't think that's going to happen, right? Especially if, the next article we're talking about, like there's a recession coming, right? So food for thought on kind of where their thinking is right now. And again, like maybe they're just talking strictly about Canada, but I'm talking about the GTA, using the GTA numbers that Trev provides. All right, next article we have here. Has the Canadian housing bubble burst? This could depend on time and place, and they are using the exact same article from RBC. Now, they're saying that basically some economists, RBC economists, right, saying that it would have burst and considerably prices have dropped below their peak in March, but unfortunately economic bubbles are notoriously hard to identify and often observed only after their burst. Nailed it, right? So I 100% agree with this because depending on which angle you're coming at this from, and this is why I was always saying, like, you need to look at the data and understand how the data is formed, right? Because you can use numbers to tell any story you want, depending on which angle you come from, right? So you can see here, the RBC economics report, you could spin it both ways. Essentially, if you measure from the highest price point to the lowest, we've already dropped 20% in GTA, which I would deem has already bursted and crashed. Could it crash some more or go down some more? Absolutely, right? But if you measure it from a year-over-year perspective, right, it's only starting in October where you had last year's price being higher than this year because that's when we started ramping up, right? So if you really want to see like a 20% drop in price, you may have to wait until Q2 next year, or call it in March, when, you know, our average price this year in March was like 1.35 mil, and you see the average price 1.1 mil, which is very likely going to happen, right? So it just kind of illustrates to your point. You need to understand what's going on using what numbers to tell you, because a lot of people just blast numbers out there just to get your attention, right? This is why a lot of people say, hey, sales are down 50%, but do they mean prices or do they mean number of transactions? And it's always trying to trick you to click on the link, right? And usually sales means transactions, not prices. All right, we got the next article here. Tiff is saying we will come out of this regarding to how Bank of Canada will still have some more rate hikes. Look, he's basically saying that they don't want to make this more difficult, which we agree. He's saying that you have to increase the interest rates to fight off inflation, which arguably I think it should be working because you're killing demand. But at the same time, when you have real negative interest rates, effectively you still have pedaling backwards right now. You need to either increase the rate so that it's higher than inflation, which right now it's not, or you need inflation to come down. And inflation is kind of coming down in the US right now, but at some point, if it can't come down, I wouldn't be surprised if they move the goalposts and say, hey, look, target inflation is now 3 or 4%, right? Which is kind of what I think is happening or will happen in the next few years. And the last thing they're saying here is that we got to get things back to normal. And so, yes, we have been raising interest rates rapidly, which seems counterintuitive. And I agree, like at some point, if they keep raising it, a lot of people will be feeling it. And you already probably may have heard some news about, like tech companies laying people off. They're saying that they can go into what they deem as a mild recession. I don't think they have control of this. Like if you look in the past, there's never been a mild recession or a soft landing. They always overdo it on both sides, either too low for too long or too high for too long, right? Like there's already a lot of demand destruction that's happened in the last little bit, and we haven't felt the effects of all the rate hikes yet, right? So if they continue pummeling the interest rate, I wouldn't be surprised if we go into a pretty steep recession where jobs could be lost, and that's where not paying your mortgage becomes an issue. Now, if you found any of this content helpful, make sure to help me smash the like button and subscribe to the Prime Process channel. And if you like the stuff that we talk about in terms of like the real estate market and you want to learn about how this applies to you and your transaction, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Okay, so we got the next article here. Bromspen, I hope I'm pronouncing it right, is one of Canada's largest private mortgage lenders, and they are now freezing investor redemptions. Okay, so let me explain to you what this means. The company takes other people's money, like say you and I's, and they invest it into other, say like real estate, right? So they lend money out at a percentage so that they take a cut of that percentage and then they return that percentage back to the person, like you and I, the investor, right? But now if the investor wants their money back, or they're saying, hey, look, I need my money for something. I need some liquidity. Hey, look, I don't like this yield. They're saying, nah, you can't take your money back. So that is an issue. And the reason why this is effectively kind of an issue is if you're the Mick, right? You lent out $1 million to somebody for $1 million property, right? Let's just keep math simple at the point. Now, because prices have come down 20%, that means that asset is now worth $800,000. So a lot of these companies are saying, hey, look, we're not going to renew your private loan, right? And we talked about this before in I think a different video. If they're not going to be able to renew the loan, the person who bore from them, that bore that $1 million, if you're, hey, look, come at me, bro, sue me for it. Then the company has to go and sue them and go through foreclosure to take the funds back. But the problem is, even if they force sell that asset, that's now worth $800,000 because it came down 20%, they're only recouping 80% of their $1 million, which is not enough to pay back the investor, you and I. So therefore, if they gate it, preventing people from taking money out, right, then they don't have what they call a bank run, or in their case, like there's too much money coming out and then they go collapse. So right now we're at a stalemate right now. because the person who borrowed that $1 million, they generally go and refinance at an A lender or they sell their property so that they can repay that loan, because nobody wants to be in private forever, right? It's just like a bridge. But now that those options are out of the way, and when you sell, the asset is worth less than what it is, it kind of reminds me a little bit of in '08 in US, where your mortgage is greater than your asset. In this case, the private loan is greater than the value of the asset. So that's why they're gating it off. So could we see more of this happen in the future? Yeah, I would not be surprised. And this is why I say we have a lot of big risk in the private lending space in the pre-construction side, which I talked about in a different video. So in this article, they kind of talk about what they were kind of lending to. And you can see there's a lot of residential development. Yeah, that's going to be real fun because that kind of ties into pre-construction as well, right? And what they're basically saying is that unusually elevated investor demands for liquidity is what they're seeing right now. And that's why they're kind of gating it. So it's unfortunate for anyone who kind of had their money with them and you can't get it out. It's just a bummer. And will we see more of this? Probably, because the values just aren't there to support the frothiness of the way they were lending out. And that's just the unfortunate fact. Okay, next article we have here. John Tory warns of massive tax hike, service cuts if the province or Ottawa doesn't bail out Toronto. Dun, dun, dun. No good, no good. So they're basically saying that they're trying to keep taxes low, which is what they ran for. And I don't want to get overly political, but like I'm all for, you know what, if the city needs money, let's just increase property taxes right now, because your municipal land transfer tax is going to come in low this year, right? Your development charges are probably not going to be that great as well this year. And if you're going to basically be pleading from, the Ontario government or the federal government to get $483 or we're going to cut services, that's going to make our city much worse. We need these services. So I pulled out the budget and you can see on the right hand side what they spend the money on, right? So you got cost shared social programs. Yeah, we should probably keep those, right? You got TDC. You should definitely keep those. Emergency services. Yeah, definitely keep them. Like, let's not cut these things, right? But when you look on the left side where the money's coming from, you got a third of it coming from property taxes. And I have no issue with paying more property taxes in Toronto. Why don't they just increase it? Why are you trying to cater to the people that are voting for you because you want to stay elected and because that's what their incentive is, right? Just so that you can make their lives easier by keeping the cost of their taxes lower on the property. Like if you own property in Toronto, you probably had a massive windfall in the last 10 years. So why not pay a little bit more tax? Toronto has the lowest tax rate in like almost every city in Ontario. It's super low. It's like 0.68%. 0.68%. It's super low. So if you could increase the taxes so that it provides a little bit more revenue to support the city and keep it great as a taxpayer and a property owner in Toronto, it's cool because the value of that asset will probably go up, right? So just pay more taxes on it, which is not an issue. But to keep it low and have it, socialized by something else is absolutely terrible, right? And you can see here in the land transfer tax, they're going to lose some money. My other question regarding this is, where is the line item for development charges? Why aren't they using some of that, right? So this is kind of like my issue, a little bit political, but like, why don't we just pay fair taxes if you have a windfall and your assets are going up? Rather than increase kind of other things because you just don't want to upset people who are voting for you. Terrible incentive on the way that we're electing our officials. Anyways, I'm gonna keep it out there. If you are looking for some help on how to navigate this real estate market, you can book a call with me using the link right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.